Welcome to the Build to Rent podcast, the first ever real estate show dedicated exclusively to helping investors go from raw dirt to a cash flowing rental property. Whether you're looking to do a massive syndication or a one-off rental property, the Build to Rent podcast will help you get there. Our hosts, Steve Olson, Chase Levitt, and Sherida Zanger, bring together more than 4,000 properties of experience as they break down how to find and finance projects, make the most of market and tax strategies, and maximize the returns of a build-to-rent portfolio. This is the Build to Rent podcast. And now, today's episode.
Welcome to the Build to Rent podcast. Steve Olson here, along with Sherida Zanger and our guest host, Lane Aldrich of First Colony Mortgage. Lane gave us some great information on the macro environment for conventional financing in the last episode. So we went into a high level. You check that episode out, the one before this one, if you want to see what he thinks about interest rates and qualifying for these kinds of loans, and is it going to be around? That's always a question. But when we talk about this kind of financing, and to clarify for everybody, 1 to 4 unit conventional financing. If you're trying to build and rent a 50 unit townhouse project, this probably isn't for you. However, if you're going to build that and eventually sell it, how you plat it and how you understand the ability to get financing does matter. In fact, Sherida, we're coming up against that on one of our projects. We won't give specifics here because we've got to figure out the details where we might be forced to use commercial financing. That affects the long-term liquidity a little bit, does it not?
Yeah, absolutely.
Yeah.
How they're going to qualify for it. It also, it's this will be a fun one to work through.
Yeah, well, we like fun ones. It's 2021. Everything's a fun one, right?
At least it should be.
Yeah, no kidding. So Lane is here, and we want to ask Lane some questions. Let's say you are a dentist and you live somewhere in Missouri and you want to build a fourplex, right? Was that random enough? A dentist in Missouri? Mm-hmm. Sherida is acting like it's not random enough. So we're going to say a pharmacist in Tennessee. Are you happy now?
Ooh, well, the
there we
stakes have been
go.
upped. Yeah.
Yeah.
Okay.
Okay. A pharmacist in Tennessee. And there's a couple of lots around the corner from your house. You want to build some fourplexes on these. You think that would be a very good idea. Well, let's talk about what that means. And I have a couple questions for Lane, and I'm sure that Sherida does as well. But Lane, the biggest thing to tell us about, what's this whole 10 loan limit thing?
What is it?
Yeah, what is it? What does it mean?
Well, it's a limit of 10 loans, believe it or not. No, it is it's a Fannie Mae, Freddie Mac. So everything, the best type of financing you can get in the 1 to 4 space is the type of financing that I specialize in. Just because you've got 30-year amortization, fixed rates, the qualifying is more standardized, and if you're working with a professional, you can typically make it a pretty smooth experience. So they feel they set their limits not off of a dollar amount that you can borrow. It really comes down to the amount of properties that they allow you to borrow against in your name. And what qualifies as that is any 1 to 4 unit property where your name is on the note personally. And once you have up to 10 of those properties, Fannie Mae and Freddie Mac have said, you're done with us. Congratulations for building your portfolio. You have now graduated on to other commercial outlets that may or may not have as good of terms, but you need to start borrowing as an entity at this point. Now, you can have multiple loans on the same property, and that still counts as one. So, for example, some people have a mortgage on their primary residence and a home equity line behind it. That still counts as one. It's not loan count, it's property count. And it doesn't matter actually what the balance of the loans are. You could have 10 $100,000 loans or 10 $1 million loans. That is not scrutinized as part of that process. But that's when people refer to the 10 loan limit, that's specifically what it boils down to.
Now, what if I want 10 loans and my husband wants 10 loans? Can we do that?
That's a great question. The answer is yes. This is something that I'll typically bring up with clients that I know want to get aggressive with building their portfolio, meaning that they've got the funds for the down payment requirements, and I can see that they want to get aggressive and tap into this financing, where if you were to do that, you would want to make sure that you and your spouse were on the loans separately, because when you co-sign on loans together and you have more than 10 loans between the two of you, that loan cannot work. So if you have 5 in your name and your husband has 5 in his name, you're already at 10. So you would want to qualify for these loans individually And there's a strategy for that. We want to sit down. Income has to be in line because debt to income ratios is the name of the game when it comes to this type of financing. So the individual would need to be employed, have a great credit score. But absolutely, that's a process I've worked out with numerous clients over the years to help grow a very, very healthy, large portfolio.
We were on a trip last week. We went down to Phoenix to check on some of the build to rent projects that we're working on down there. And I asked Lane, because I try to buy a fourplex or two every year for myself, specifically taking advantage of this kind of financing. I've got other things going on outside of that, but it's just such a good long-term investment. That true 30-year fixed mortgage, as long as you make your payment every month, nobody's bothering you.
Yeah.
That's not the case with commercial. We can do that on another episode. But I looked at you and I said, Lane, I've been qualifying for these loans all by myself. I'm getting close to 10, I think. I can't go much longer. My wife has 0 loans in her name. Now, she helps me run our business. She's very much a part of it. I said, can I make it official, right? And employ my wife, because I get paid through an S corporation, which can have employees, and then she can have the documentation necessary that a lender says, oh yeah, you make money, I'm going to give you a loan. So what do you see on that when spouses need to qualify, especially like when there's some self-employment in the house? What are some tips and tricks on that?
Sure. The term self-employment is very broad in a lot of these situations, but doable. It really comes down to an individual has to show that they have a 2-year work history. That 2-year work history does not all have to be with the same entity. It just has to be 2 years total, and specifically being on the job most recent for at least a 6-month period. Ideally, this individual in this type of situation would be W-2'd, because if you didn't make it W-2'd and this individual or spouse became a partner in the business, that switches to a different guideline parameter where now she has to be self-employed as a business owner with you for 2 years, and then it's averaging that income over a 2-year period. So the path of least resistance to get this done is to make a spouse a W-2 employee. And I've got multiple clients right now who are facilitating this type of setup to expand their portfolio, and I've worked with a lot in the past, done the same thing. Pretty common. There's nothing wrong with it, and it's a great way to continue to tap in the financing.
Okay. If I had $1 for every time I was talking to an investor and they said, well, I think I can get a rate of 2.875 because the Quicken Loans guy said so last night on TV, then I'd have like $70.
Probably in the last week alone.
Yeah.
Yeah, I'd have like $200 yesterday.
Uh-huh.
Yeah.
So I'm going to leave it to you to elaborate on that, but why is that wrong? Talk about the actual terms and some of these restrictions that investors get duped by. They think they're getting some of the attributes of an owner-occupied loan when in reality they are not. What does an investor loan actually look like?
Sure. So something that's common that comes up a lot is Bob, the loan officer, who may work for a Quicken or an online company. The bulk of the transactions that they do are primary residence, single-family homes where you're calling in and saying, I want to refi my personal property. And so they're just built and geared to give information and quotes based off of that format. Interest rates for investment properties are different. On a 30-year fixed, there's a little bit of a risk adjustment when as the entity lending the money is making an assessment of what they feel the interest rate should be or what the risk factor is. And so a fourplex is typically 0.75% higher as an investment property, 2 to 4 unit, than a primary residence single family home. And so it's easy to go online and get a quote. A lot of quote systems don't know how to run investment properties very well, but there is a difference. And so when you're working with someone and you're trying to collect information on what the financing looks like, you need to make it very clear that you're working with someone who, one, first of all, understands investment property financing, and two, understands that this particular property is also investment financing. Because I've got a lot of clients that I work with, and I always want to make sure we're competitive on the market and offer great terms and rates. And sometimes someone will send over a sheet, and I have to say, look, that's not real. But if you ask all these questions, then I can offer that. That's great. But chances are it's probably not going to happen because Bob, the loan officer, is a great guy. He just doesn't
do investment properties a lot.
Right.
That's funny. I got a text this morning from a gentleman that just said, hey, We got a second quote, and it looks like it's a little bit better than what Lane's team sent our way. I haven't replied back to this gentleman, but obviously what I'm going to reply back is we want to make sure we're comparing apples to apples. Please send that over to Lane, and his company will match or beat whatever that is. Because usually, again, like Lane was saying, you're not looking at the same product type. They're just giving him a rate, and he's not going into all the detail of what really he is purchasing, and maybe they don't even understand what he's purchasing and don't specialize in fourplexes like Lane does.
Yeah. And again, too, a lot of the products that I finance are new construction 2 to 4 unit where there's a lot of moving parts. And so we do want to make sure we offer the best rates and pricing. If somebody sends me a sheet, I take it right back to the lenders we sent it to and say, hey, someone did better than you out in the market. And we make them come down and beat it. And so our capture rate with the developments that I'm associated with are typically very high from a competency standpoint and us understanding working with investors, understanding the development, and also making sure our pricing is competitive to help yield the best cash flow as well. So these are all things that we're very cognizant of. It's a fun word. And making sure that we get that message out in front of investors, because when someone has to call, if I'm a preferred lender for a builder and they'll call and say, oh, hey, I already have my investment loan officer, and I say, that's fine. I said, why don't we talk about this one? Expertise and knowledge goes such a long way that a lot of times by the end of those phone calls, they'll say, hey, can you finance all of my properties from here on out? And my last guy was just really nice. You just have a deep understanding of how these work better than anyone I've spoken to. So I always like those. I'll give myself a little fist bump at the end of those conversations.
Yeah.
Because typically I'm alone and there's no one to high five when I...
There's nobody there.
Yeah.
Well, you got your plug. No, we didn't intend for this to be a plug. We genuinely, a competent lender, whether it's Lane or somebody else, makes your life so much different. Now, I want to highlight the fact this is the Build to Rent podcast. We've just been talking about getting loans that could be on anything. But when we bring construction into this, right, that's not a Fannie Mae. That's not a conventional product. A construction loan is unique and it's different. Mm-hmm. I mean, your model is you approve somebody for the long-term Fannie Mae, take that to a local bank who then approves a construction loan, knowing that, was it Phil, the optometrist from Rhode Island?
Yeah, something like
that. That Phil is qualified by Lane to do a takeout loan or that long-term loan. So tell us what your observations are and what you see when it comes to a construction loan. I want to get a loan and build my fourplex. Sure. What should I expect?
Well, no, first of all, we have to acknowledge that Phil is very multi-talented. If he went from a
pharmacist in Tennessee.
Oh, he was a dentist in Missouri earlier, but he changes his name a lot.
My goodness, this guy. So that is different. And this is, I'm just about to roll up on $500 million in loans for this type of product, which means about $300 million of that was brain damage. When building out this process and understanding how to do this at scale.
I was there for much of it.
Yes, those were there were some tears shed.
By you. Yeah. I kept it together.
Okay, well, fine. Yeah. You don't have to admit to it on air. So it is a little bit different from a build-to-own perspective with the formats that I'm accustomed to, because banks are not super keen on lending money for investment properties. They consider that, quote, speculative financing, and they really want to limit the amount that they're issuing in that financing bucket, so to speak. And so I have to come in and convince them to do an entire development based off of my underwriting requirements that they don't want to deal with as someone that they don't understand. And then by the end of the development, I have to have them think, okay, Lane actually understands these developments and these programs better than our own loan committee, because every time we challenged him on how he got his income or backed into debt to income ratios, he was correct. So in the different states that we lend in, have it come into my office, we look at it from a Fannie Mae, Freddie Mac perspective. One of the most exciting things I'm excited about to tell investors when they call in and say, hey, I don't know if I'm going to qualify or not. This is so foreign to me. What's going to happen? We can use rents from the fourplex that's being built for qualifying purposes to offset that payment.
How much of those?
When it's not even built and there's no tenants, and we can use up to 75% of whatever an appraiser will determine fair market rents are for that property when it's done, without leases. And this kind of there's not a lot of new construction fourplexes in the market, so Fannie Mae and Freddie Mac have just kind of left it as a gray area, and this is how they've interpreted it, and it's been that way for over 10 years. So very, very favorable for investors that want to come in and do one build to own fourplex, let alone multiple, if you're not working with a multi-million-dollar annual income, you can make a couple $100,000 a year and put up a couple different fourplexes at the same time, when a lot of people felt that something like that would never be achievable. Mm-hmm. But getting familiar with all these different banks, understanding what their guidelines are, and then making sure I underwrite accordingly has definitely been an undertaking, but allows me to advocate really well on the fourplex owner and give absolute answers on if you're going to be able to move forward on a property or not. And that's been an exciting part of what I've been building out for the last 5 or 6 years.
You inadvertently danced around debt to income ratio. Mm-hmm. When we qualify for a commercial loan, this is referred to as a global underwrite, right? The bank looks at you, the asset, they take everything into account. The kind of loans that we're talking about on Fannie Mae, right? That is so, I think credit score and debt to income ratio are like 95% of this equation?
Yeah.
Maybe more. And so a lot of times people worry, well, I get more properties, more debt, it hurts my ratio. Now, if you're buying good investment properties, wouldn't your debt to income ratio be getting better the more debt you get?
Better, or essentially just stay the same. I mean, because we're only using 75%, and you've got that delta that we just have to essentially eliminate for those conservative purposes. Someone can come in and say, I want to qualify for a primary residence, and I look at what their debt to income ratio is, adding that primary residence or that new housing expense, and let's say it's 31%. Let's say that this house, principal, interest, taxes, insurance, any debts the individual has, car payments, student loans, credit cards, personal loans for a new Mastercraft boat, or maybe a Nautique G23, it's a great boat. All of that totals 31% of this individual's gross monthly income, right? So that's what you pinpoint as their debt to income ratio. Then they can come in and say, now I want to add a fourplex. And I go ahead and add what this potential fourplex would add from a cost perspective. And then the liability perspective as far as the monthly payment, principal and interest, taxes, applicable HOA dues. Then I can plug in the applicable rents that I can use to offset that payment. And this individual's debt to income ratio could still just be right at 31%. Now, once you have built this fourplex and it is considered a retained property at that point, if you have it at that point and you don't lease it out, well, then your debt to income ratios are going to be completely out of whack because you have a non-performing asset where you've got
you don't have income for the debt.
Right. So at that point, once you have completed the fourplex and you refinance and you own it and you want to go buy an additional property after that, you're going to have to show leases to be able to offset that payment. So that's when that becomes important. But at the time of completion and turnover, it's just whatever an appraiser says fair market rents are. And that's been wonderful with us understanding that, and the banks working with us in working on these pre-approvals for investors. It's helped us get more aggressive with qualifying and getting individuals to build a bigger portfolio than I think they thought was possible.
I have 2 questions. Number 1, did I just see you try to get Mastercraft to send you a free boat?
I think so. But
no,
if they
not
do...
Teague. What are you talking about?
Maybe a little bit. I mean, X-Star, any Mastercraft dealers out there,
great
DME,
products.
Oh, wonderful. But G23 Paragon Nautique is kind of the king of the water right now too.
Yeah.
Or G25.
Yeah,
Shared a
come
smiling
hang out
at
with me.
Yep.
Okay.
So
It
had to be said.
If we get a free one out of the show, then we'll post a picture on. Do we have a website, Preston?
We have the domain.
We're doing some stuff. That's essentially what Preston said.
Okay.
Yeah. So then a more real question is, what debt to income ratio makes Fannie Mae say no mas? We're not doing this loan.
You can actually get up to 48, 49%, which is pretty ludicrous in a lot of ways. I like to cap it at 43, 44, because on the front end, when you're prepping to build a fourplex, there's a 3 to 6 month process. Then you break ground, and then there's another transaction that takes place upon completion. And so when I'm doing a risk assessment to see if somebody qualifies, it's a dynamic approach because I have to see, does this person qualify now? And is their income or expenses trending in a way that they will likely qualify again for the refinance a year after that? And so I do like to leave a little bit of wiggle room in case someone's expenses do fluctuate or change. But I'm trying to typically hit the 43% number for the type of product that I am pre-approving for.
So let's talk a little bit about 1099, because I'm a 1099 employee. My husband owns a company as well. And so I usually, when people say, hey, why is it important to talk with Lane? Why is it important to get pre-approved? And my main thing is, one of the things you want to make sure is that you can qualify. And by that, if you are a 1099 self-employed person, you're going to want to make sure that your taxes are structured in a way that you can qualify. I know that Lane says that, hey, he can add some of the depreciation back in. So every year I do my taxes. I have my accountant send my taxes to Lane and say, Lane, hey, this is my goal. I want to buy 4 fourplexes this year. Or my husband wants to buy 2. I want to buy 3. And we're going to buy a second home. Whatever it is, I paint the picture to Lane. Lane looks at my taxes and says, okay, you need to structure this slightly different or do this slightly different, or no, those look great. So that, I think, has been a key benefit to me, is being able to use Lane. And I know I tell that to investors all the time, because his knowledge of looking over your tax returns for someone self-employed, I think, is huge.
Yeah, and you hit on something that's really important with working with the right people in this type of situation, where there's a lot of moving parts for a lot of business owners, in the sense, how is your income projecting? Are you going to sell a stake? Are you selling your company? Are you growing? Are you downsizing? Where I can assess that, and a lot of it's not just, hey, so I can buy 1 fourplex, or it's, hey, how do I need to file my taxes this year? Because I want to strike the fine balance as a business owner, is making sure I show enough income to qualify, but I also don't want to overpay Uncle Sam, because that's no fun for anybody. And so I can actually go in and make that assessment and say, all right, based off of what your plans are for this year, let's make sure that you don't get as heavy in certain deductions that could ruin your plans to acquire additional properties. So that's fun. I'm happy to do that with investors as they call in on the different developments that I'm associated with. And I think we do it better than anybody in the country, just because we eat, sleep, and drink fourplex new construction financing.
Yeah. Overpaying Uncle Sam is the worst.
Yeah.
Mm-hmm.
If you overpay him, he won't tell you.
I don't think he'll give it back either.
No, he doesn't.
Yeah.
He doesn't.
Didn't want to.
Can you use cryptocurrency as an asset?
I hate that question. Because I wish it was yes, and the answer is no. The mortgage industry is never quick to adapt to something that is that significant, especially when the name of the game in finance is paper trail, right? If you're going to come in and put 25% down, we need to make sure that was legit your money, and that you are not borrowing, and therefore we can calculate a true debt to income ratio. Because if we can't paper trail that money, we have to assume you borrowed it, and how do we know what your cost is? And so how can we pinpoint a debt to income ratio to show that you qualify? Because everyone got hammered in the recession in 2008, 2011, because there was a circus going on. There was no paper trailing, right? And then
That's the essence of crypto. No trail.
There's nothing.
I mean,
man.
why do you want to buy drugs with a trail?
You can't. I wouldn't. I don't. I'm just throwing, making sure that
You don't buy drugs with a paper trail?
Did you listen to that book that I told you to listen to?
No, which one was that?
Oh, that's what that book was all about. Oh my gosh, you guys, this was like a phenomenal book on Audible.
I just finished a book called Bitcoin Billionaires, the Winklevoss twins. And when Bitcoin first started, the big knock on it was Silk Road, which was a massive...
That's what this book is about.
Okay,
American Kingpin, about Silk Road and the guy that started it.
That's really interesting stuff. Yeah. So the very purpose is to be anonymous, and that's the last thing a lender wants. A lender wants to verify your income.
Yep. So because you can't paper trail it very well, a bank statement, I can go and say, hey, I need a 30-day e-statement. Well, this is Tom Jones with Fidelity, 30 days, incoming deposits, outgoing transfers. That meets guidelines. The industry is just not caught up to crypto, and also Lane has not caught up to crypto. And so I feel like I'm a little out of place in this room, but we can move past that, I think.
Yeah, Preston's pretty heavy into the crypto.
I know. Everybody is.
Shiba Inu.
Right?
I heard that one. That's the new one. It's
Yeah.
got to be a dog.
It's really
Yeah.
dog frenzy right now. It's all about the
We don't
dogs.
know anything about crypto. We don't pretend that we do. It's just I know that. I get that question.
Do we need to make a financial disclaimer that this is not, that if you invest in Doge right now, that we're not saying that's going to turn into something great?
It's going to the moon.
Okay. Yeah. We're mooning.
Yeah.
I do know that term.
Yeah. Okay, we'll probably have Lane back soon. He gives some good information, and we appreciate you coming on the show, Lane. Everybody, that's it for the Build to Rent podcast today. We'll catch you next time. Thank you.
Thanks for listening to the Build to Rent podcast. You are now just a few clicks away from joining our community of Build to Rent investors. All you have to do is follow our show on Facebook, LinkedIn, or wherever you're listening to this podcast. You can also watch this episode and more by subscribing to the Build to Rent podcast on YouTube. The information presented in this podcast is general in nature. Nothing in this presentation should be construed as financial advice or recommendations for any particular situation. The hosts are only licensed to provide advice and services in the states where they are specifically licensed, and listeners should seek the advice from an appropriately licensed professional in the area where they invest. The examples presented in this presentation are for illustration only, and no guarantee that similar results can be achieved, since the facts, circumstances, and participants are all different.